Something remarkable has happened this week. Yesterday was Monday, today is Tuesday, tomorrow is Wednesday, which is when Jerome Powell is going to hold the press conference after this month's FOMC meeting, which is the Fed Open Market Committee, in which he will be revealing quite a bit. I'm pretty certain I know what he's going to say. I think he's going to say that he's not going to taper and that he's not going to raise rates. He's not even thinking about it. But there is some uncertainty. We don't know for sure until he actually says that he's going to do absolutely nothing. But yesterday and today on CNBC, on Bubble Vision, on the channel where the Fed can do no wrong, where money printing is wonderful, where stocks always go up, where their viewers have never heard, at least in the last few years, people who have been watching CNBC in the last few years have not heard a bear, period. They've heard no bear case for this market. They have no concept of any, there's no inkling in their mind, based on what they've seen on CNBC, that there's anything to be worried about, that there's any potential crisis on the horizon at any point in the foreseeable future. Well, I have to say that bubble that they've been living in was burst now 2 days in a row by major CNBC guests. Firstly, yesterday, Paul Tudor Jones, who's a pretty famous billionaire, the kind of guy who, when he decides to go on CNBC, they clear their time slots, whatever. They'll let him talk for as long as he wants because they want him on the air for as much as they can get, because that's the kind of guy who's going to draw eyeballs to CNBC. People are going to unmute and turn up the volume when Paul Tudor Jones comes on the screen. And what did he say yesterday? Paul Tudor Jones said a lot of the same stuff I've been saying. He says that inflation is not transitory. He said that essentially you need to buy gold and crypto, and I don't feel comfortable saying you need to buy gold and crypto because I don't give investment advice. Remember that. I'm just here giving economic commentary. But Paul Tudor Jones's investment advice that he was giving on CNBC yesterday was rooted in the same sort of economic opinions that I've been giving on this channel. He said, using his exact words, go all in on the inflation trades. What does that mean? Inflation's not transitory. It means that inflation is probably higher than the Fed is saying, and that you need to invest accordingly. This is not the sort of thing that CNBC viewers are used to hearing, because if inflation is real, if inflation is not transitory, perhaps they don't know this yet, that's not a good thing for the markets. What has enabled this meteoric rise, this massive bubble in everything, which, oh, by the way, back from the dead, Michael Burry, who, completely nuked his Twitter account, after the SEC came knocking on his door because he was talking too much about inflation in Weimar Germany. The SEC came knocking on his door and said, hey, you're speaking too much truth. The normies might figure it out. What's going on here, and so you need to stop talking about that. He came out and started speaking out again today. This morning, he tweeted something, I believe it was like, hey, people keep asking me what's going on. And what's going on is the greatest, the greatest bubble in everything, in history, by 2 orders of magnitude. And so we've got 3 pretty big, important investing icons coming out this week, echoing my sentiments. And I haven't even gotten to Kyle Bass yet. There's been so much news on the inflation front yesterday and today. And of course, it was just last week we got the CPI numbers hit 5%. That's a big psychological number, 5% inflation. And, I lamented that the bond market is not responding accordingly. I had hoped that once inflation started to break out, the bond market would react appropriately and would increase the inflation premium built into the rate of interest, and thus interest rates would rise without the Federal Reserve actually raising them on their own. Because, in a normal market economy, interest rates are supposed to be above the rate of inflation, because whatever the rate of inflation is, let's say inflation is 5% and the rate of interest is 5%, you're making 0%. So in order to make a positive rate of interest, which typically you want to do if you're loaning out money, you want to loan out money and get more money back than you loaned out, the rate of interest needs to be above the rate of inflation. So, with that in mind, if the rate of inflation is clearly well above the 2% target of the Federal Reserve, if it is in fact all the way up at 5%, at the very minimum, because that's the 5% that the government is willing to admit to, as Kyle Bass pointed out today, is much higher. I'll get to that. The rate of inflation should, or the rate of interest should be above 5%. We're not seeing that. The 10-year is at, it's gotten as low this week as 1.46%, I think. And considering that, it's abundantly clear. Real interest rates are negative, and I've seen no signs that they're going to change, unfortunately. I didn't want that to be the case, because I thought the bond market was our last line of defense. And, I've been kind of at a loss ever since I came to that conclusion that this is where we're at. But again, most of the market doesn't think that that's the case. Most, if you're an average CNBC viewer, you think that the rate of interest on bonds is so low because inflation is transitory, and it's so transitory. This 5% inflation is going to be such a flash in the pan that the rate of interest on a 10-year bond can be, less than 1.5%. The yield can be less than 1.5% because, on average, this 5% rate right now, over the next 10 years, it's going to average out to below 1.5%. That's still a positive rate of return as far as these people are concerned. And Kyle Bass came on, thankfully, and burst that bubble. He made it clear to them, no, it's not that the bond market is pricing in such low inflation. The bond market, yields in the bond market are just negative in real terms. And in fact, he went even farther than saying that. Kyle Bass went so far as to say that negative real rates are probably around 10%, which means that he is saying that the rate of inflation, depending on which bond you're comparing it to, whether you're comparing that to the 3-month note or to the 30-year bond, is anywhere between 10 and 12%. And that's right in line with, kind of the estimates that, that a lot of us on the CPI skeptical end of the spectrum have been thinking. I think it's pretty hard to believe that at this point, if the CPI, the official CPI headline number is 5%, it's hard to believe that we're not in the double digits. And Bass even went on to say that the CPI is engineered to understate inflation, and that I can't remember the exact verbiage he used, but he said something like it's a measurement that's weighted down with chains. And this is the kind of talk between Paul Tudor Jones and Kyle Bass, today. This is the kind of talk that the CNBC audience is not used to, and this could, really seriously shake the resolve of retail traders. Remember, over the last year, a huge part of this massive run-up, the last stage of what I hope to be the last stage of this terrible, awful, no good, everything bubble, has been this huge surge in retail traders taking their stimmy checks and going into the stock market and just buying everything, getting on there with their pal, with Davey Day Trader, and throwing darts at a board and buying whatever stock their dart hits. And it's not just Dave Portnoy and his band of merry men on Robinhood. There's been a ton of retail traders over the last year. And so if the retail psychology begins to shift, because remember, when times are good, retail loves to be in there. And when you're an idiot if you're not in the stock market when times are good. And when times are bad, you're an idiot if you are in the stock market as far as retail is concerned. And so when their sentiment is so one-sided, Something like this, I think, could begin to change the tide. These guys, these important guys going on a network like CNBC with its army of brain-dead viewers, I think that they could make a dent in their sentiment. And I also would like to praise Kyle Bass for bringing up the housing crisis in this country, because normally, like last time, it's considered a housing crisis when prices go down. It's never considered a housing crisis when prices go to the moon and all these boomers who already own homes become multimillionaires, and the younger generations that don't own homes end up, either living with their boomer parents, like I am, or end up living in these crappy apartments, with half a bathroom and no shower and cardboard walls or something like that. Hell, there was this, not to get too off topic, but there was this funny viral Facebook marketplace post that was, I believe it was literally a 5x5 cordoned off section of a living room in somebody's house in Portland that was divided with, I think, cardboard, and they wanted like $600 a month, and they said, oh, and by the way, prostitutes live in this house. It was a whorehouse, and they were trying to rent for $600 a little corner in the living room, and they were basically saying, hey, you need to be comfortable with listening to noisy intercourse at all hours of the night. So that anecdote aside, Kyle Bass was talking about how housing prices are completely unaffordable for a good chunk of the American population these days. And the Fed, what they're doing in response to that is they're buying, I believe he said, $6 billion in mortgages every day. They're dumping $6 billion into the housing market, boosting the demand for housing by taking mortgages off the balance sheets of banks, essentially creating demand for mortgages, which is incentivizing the banks to keep writing more and more mortgages at lower and lower rates. And of course, as the easier it is to get a loan, the lower you can get your interest payment, the greater you can make the principal on that mortgage. And so that drives up prices more and more. As I've explained before, people don't, when they're looking at the price of a house, they don't look at, okay, what is the price of the house? They look at, what is my payment going to be? And so if you are making around $95,000 a year, like this woman that CNBC recently profiled, you can afford a house that, is about $250,000. And that's with almost zero money down. If you actually have a decent down payment and you're, able to avoid paying PMI, which is private mortgage insurance, then you could actually afford an even better house. But again, at that level of income, you can finance at this point almost $250,000. And so the bar for what is a $250,000 house has been lowered substantially. I mean, again, I've said this before, a $250,000 house where I live is a hellhole. It's unlivable. And the reason for that is because of the Fed creating so much demand for mortgages, which is creating a demand, or which is incentivizing the banks to inflate the housing market again, just like they did last time. It's the exact same damn story. Now, to get to the breaking news from this morning, the Producer Price Index came out, which is that is the producer's companion to the Consumer Price Index. Consumer prices are the prices of end goods, like what you buy at a retail store. Producer prices are the prices of intermediate goods, of materials that producers use in order to manufacture stuff. And unsurprisingly, not only did the Producer Price Index beat expectations, it is, of course, higher than the rate of consumer prices, because when prices are rising, producers, they don't like to raise prices on their customers too much. And so even when consumer prices are rising, they're not going to rise as fast as they are for the producer, because the producer is trying to absorb some of that added cost themselves, so as not to inconvenience their customer and to alienate them. and also because of competition, because you don't want to be the first one to raise your prices. If you're the first one to raise your prices, everybody's going to go shop at the other guy who hasn't raised his prices yet and isn't making as big of a profit as you are. If his profit margin is shrunk, that's not such a bad thing if he gets all of your customers in addition to his existing customer base. And so that's why, even though the CPI is up 5%, I believe the PPI, the producer price index, is up about 6.6%. And this is a result of the decline in production, which again is something else that Bass pointed out in this interview. Pointed out that retail sales, in nominal terms, have exploded in the last year, yet unemployment or employment is still down about 8 million since the start of the whole Wu flu episode last year. There are 8 million jobs that have not come back, and yet retail sales have already completely recovered and have gone above and beyond. And so what that means is that consumption has been replaced, but production has not. People are not producing what they were last year. And what is the result? As I say this time and time again, if you have more consumption and no more production, you're going to have higher prices. Or if you have less production and the same amount of consumption, you're going to have higher prices. Prices are only stable when you have a balance between production and consumption. Because no matter how you play with the numbers, you can never consume more than you produce. Now, to counter all of that, there is still the argument that must be considered of I don't know what to call them, maybe the transitory defense squad, the people who defend the idea that inflation is in fact transitory. Here's a counterpoint to you to everything that I've said today. Retail sales missed expectations. I believe it was down like 1.7% or something, 1 point something, which might not sound like a lot. But the fact that retail sales missed to the downside shows you just what happens when we don't have more stimmy checks. Because it's been a while since the last stimmy check. Stimulus is what's fueled this so-called recovery. Stimulus is what has replaced all of the consumption that was lost by U.S. consumers when they quit working and quit producing goods. Their consumption has been replaced with stimulus, and so when the government does not stimulate directly, when the federal government, and again we've come way down this road. I keep talking about how the Federal Reserve and now the federal government keeps having to stimulate more and more, taking more and more extreme measures over the years, going all the way back to 2008, in order to keep the bubble alive. And this is really the final step. In order to keep this bubble alive, the Federal Reserve must not only keep interest rates low, because that's how they blew the 2008 bubble. In order to save the 2008 bubble and keep it from collapsing completely and to start a new bubble, they had to start quantitative easing, which was buying up assets out of the open market, buying up bonds. And that was good enough until 2020. And then in 2020, then the federal government had to start directly stimulating in order to prop up the bubble. And if we don't have that stimulus on a regular basis, if we don't get our $1 trillion stimulus every couple of months, then these economic numbers are going to start to slip. And so I stand by everything I've said today and in the past about inflation. But that is all predicated on the idea that the federal government will continue to stimulate. There needs to be more stimulus coming down the road. There needs to be a perpetual extension of mortgage forbearance and of the eviction bans. All of these temporary expediencies which the federal government undertook in the year of 2020 need to, and I'm not saying I want this to happen, I'm just saying in order for the inflation narrative to play out, to continue to play out, all of these things must be held in place and they must be continued. We need essentially a what do they call it? Basic minimum income, or no, what do they call it? Universal basic income. That's a new term. Basic minimum income, I think, was an old Milton Friedman term, maybe. Otherwise, the bubble cannot sustain itself. There's not enough production in this economy. Retail will have to deflate. People will have to stop spending so much money. And when that happens, the whole house of cards will begin to come crashing down. Now, as soon as they see that start, the federal government is going to come right out and start stimulating again, even if they stop. If they think they can stop now and they don't, and they do, things will start to come apart, just like they did in 2018. And then the feds, collectively, Congress and the Federal Reserve, will have to come out and do something about it. They will. They're not going to stand by and let it happen. Powell made that clear. And, you know, these folks, these clowns that we have in Washington, they never want to allow a recession in their term. They're looking in terms of a 2-year time frame. Every 2 years, they got to get reelected in Congress. And so they can't allow a recession, because that'll be on them the next time they come up for reelection. Their constituents will blame them. And so even if we start to see inflation cool down a little bit, and we see a collapse in retail sales because the federal government is not injecting so much money directly into the pockets of consumers, they will resume as soon as they start to smell any trouble. So with that said, I will see you folks back here tomorrow.